the Visionary Investor Podcast. I'm your host, Andrew Marks, and I'm a stock market wealth investment mentor, speaker, and entrepreneur who has a passion for all things stock market investing, diving deep into quantitative and qualitative analysis, creating formulas and calculations that optimize stock market investing, and creating a life that fits your biggest and wildest dreams. You're in the right place if you're ready to tap into some investing strategies that aren't taught without getting a degree, working for an investment firm, and some that aren't even taught anywhere else in the world. Find deeper clarity on your investments and what your future can hold. Strengthen your understanding of recession, stocks, and your money, and learn the tools to accelerate your investments and wealth. You're here to be a visionary investor, not an average one. A passionate disruptor with uncommon goals in the investing world. It doesn't matter where you are in your investing journey. You're never too late to become a successful investor, and I'm here to help you do that. Let's get into the investing flow. Hi everyone, and welcome to Stocks Home Run or Strikeout. What would you do with this stock? We're going to look at two stocks today: Netflix, ticker symbol NFLX, and Dish Network, ticker symbol DISH. Stay until the end of this episode and you're going to hear my rating on these two stocks, whether they'd be a home run or a strikeout. If you want to choose a stock for the next segment of Stocks Home Run or Strikeout, send me an email to support@thevisionaryinvestor.com or send me a message on Instagram @thevisionaryinvestor. Alright, so this is a first level analysis that you can do in order to figure out if a stock is potentially good for your portfolio and your goals or not. Think of this like a stock screener. Each stock will be broken down into 3 different segments with the opinion at the end. Stock basics, 10K, which is looking over brief information from a company's annual report, and Glassdoor. One big metric that we're going to look at in an annual report is earnings per share, because this is a number that helps to predict a stock's future price. So EPS, or earnings per share, is the earnings that you can expect to receive per share you own. These earnings are not directly paid out to you, but it's a prediction of what your shares are technically worth as a part owner of the company. You're subject to part of it if the company paid out all of its profits to shareholders. Earnings per share is calculated as the company's profit divided by the number of shares that are outstanding of its common stock. So if we look into this a little bit further, when the company's net income is rising, and let's say the number of shares outstanding stays the same, earnings per share will rise. And in reverse, if the company's profit or their net income overall is falling with the number of shares outstanding remaining the same, the company's earnings per share will as well fall. This is just a really quick telltale sign of what's going on. How well is the company managing its operations and day-to-day? Are they growing the company, or is the company actually declining in its profitability overall? Maybe they're taking on too many expenses. Maybe they're trying to invest for the future but having trouble. There's a lot of things that could be going on here, but it's a quick telltale sign of what's the profitability of the company. So first, if we look at Dish, it's in the communication services sector. The market cap is $3.9 billion. Over the past 5 years, the annualized return has been negative 26.1%. The 5-year risk has been 32.1%, and the risk-adjusted return is negative 0.98. Just a reminder, downside risk is using downside standard deviation. So we're looking at dispersion of stock returns that were negative each month over this 5-year period to understand what the risk level really was. The earnings per share trend, or EPS trend, increased from 2020 to 2021, but it decreased from 21 to 2022. Now, one thing I want to note from their 10K is that pay TV service makes up about 75% of the company's total revenue, and this accounts for Dish TV and the service you guys may know about, Sling. Now, this total number, though, of this revenue decreased from 2021 to 2022, and it's important to be aware of this because at the end of the day, is a company like Dish going to be able to innovate enough to continue to grow in the future? That's a big concern I have when looking at this company. And also seeing that it's had negative returns over the past 5 years is not a good sign to start with. Lastly, when we head over to Glassdoor, we see a CEO rating of 52%, which is very low, and a company rating of 3.1 stars. Now let's take a look at Netflix. Netflix also is in the communication services sector. Market cap a lot larger, $178 billion. 5-year annualized return, 2.4%. 5-year risk, 35%. So the risk-adjusted return, again, it's negative. This time it's a little less negative, but it's still negative 0.08. The EPS trend was the same. It was increasing in 2020 to 2021, but it decreased from 21 to 2022. And one thing to make note of is streaming revenues here for Netflix make up a total of about 99.5% of the company's total revenue. When we get over to Glassdoor, we see Netflix CEO rating is 91%, much better than we saw for Dish. And we notice they have a 4.3 stars on their company rating. That being said, what would we rate Dish and what would we rate Netflix? Unfortunately, both of these companies, in my opinion, are going to be strikeouts. So Dish, seeing that returns have been negative over the past 5 years, coupled with the high risk level, anytime I see this, I always look further into management to see how they're running the company and what's really going on under the hood, because this is definitely a red flag. Now, Dish is definitely competing in a difficult industry that's constantly changing, and they're seemingly losing market share. I didn't like seeing that their pay TV revenue was declining in 2022 compared to 2021, considering that's a majority of their revenue. So how will they move forward to innovate to ensure long-term sustainability? And lastly, seeing the rating on Glassdoor being low for both the CEO and also the company raises those additional flags that I was just talking about. Do people like working at Dish, or are there some issues with management and the company morale? Because this will make it a lot harder for them to grow long term. And it's such an important factor that so many people miss out on when looking to buy a stock. Again, when I say this, it does not mean the company cannot turn around, but based on what I'm looking at and how I'm observing the company, I wouldn't say this would pass my first level of a stock screener. And now let's take a look at Netflix. Obviously, it's a larger company. They have had positive returns over the past 5 years, but there has been a lot of risk. We have noticed a lot of price fluctuation. If you actually look at Netflix's stock over the past 5 years, you'll notice it has gone up and down a lot. Some of the large stock price fluctuations have definitely been understandable given what happened with COVID and the difficulty or inability for Netflix to film new series and to have new series on their service. So this has definitely been a difficult area, but I think they've done a really good job coming back from this and increasing their subscribers or the number of members that are currently paying monthly for their service. Now, they do get strong CEO ratings. I do like their focus on original content, and when they do put out original content, it seems like they're getting better margins overall, and that's drawing people to their platform over other platforms, or that's also preventing people from canceling those subscriptions. But that being said, I still think there's room for their company to grow in a way that it's more stable. I don't want to see such high fluctuations in a stock price when I'm looking to invest into a company longer term, because it makes it a lot harder for you to know, is this truly a good investment? And it's so much easier to just get emotional when you're seeing large price jumps in a company's stock. So generally, I like to look at a 5-year risk level below 20%. These stocks may work for your portfolio. You may like these stocks, and I'm not saying that they're necessarily bad stocks for you. I'm just saying, in my opinion, they're strikeouts. Please make sure to always do your own research first. This is purely my opinion. I'm not a financial advisor. Past results do not guarantee future results, and investing in the stock market always has risks. So make sure to do your homework and make sure before you invest into anything, you're comfortable with the risks you find and the potential return that you could receive. Thanks for spending some of your time listening, and don't forget to subscribe to the podcast, leave us a kind review, and follow us on all other platforms at The Visionary Investor. Have a great day.